Want to, yep, thanks, Elizabeth. So welcome everyone. Good morning. My name is Michelle. I'm honored to be hosting this morning. So it's the Cando Links to Learning. This week has been exceptionally good. We've had, the topic has been financial literacy. And so we've had actually we're gonna have, by the end of today, we're gonna have 4 different presentations. So say you came here today, you liked what you heard, wanted to hear a little bit more. There's 2 other presentations that were recorded on Tuesday. So if you go to the Cando website, you could go watch those. Really good content, really good information. Financial literacy is really important. I think of economic wellness, financial wellness. So when we educate ourselves and have that understanding, of the finance piece, that only will benefit our communities and the organizations that we are part of. So really good topic, really honored to have Alex and Monica join us this morning. Feel free to use the chat box. I'm joining from Edmonton, Misquithia, Treaty 6 territory. So it's sunny here today. I'm giving thanks to Creator for a gift of this beautiful day. Every day is a gift to us. Every day is a learning opportunity. Every day is an opportunity of possibilities, of growth, of being in community. And I realized, after a year of being in this pandemic, we've learned to be in community virtually. So we're really thankful for this opportunity that we can still gather, we can still learn. I know it's not the same as being in person, but we still are able to learn and gather together in community. So thank you so much for being here. We're really honored. So a couple of things. There will be an opportunity for question and answers after the presentation. So feel free to ask any of the questions that you have in the, throughout the presentation. You feel you might have a question in there. Feel free to use that chat box and put it in there, and we'll be sure to get to it. There also will be an evaluation link sent to you. And this is important for us, from behind the scenes to, collect your feedback. As we continue this series for a couple more months, it's really important to hear what you have to say. And when you fill out that evaluation, your name will be entered to win a draw. And so there's 2 $400 Visa gift cards up for grabs this week. So all you need to do to get your name entered into that draw is fill out that evaluation. All right. And I also believe that this PowerPoint will be emailed to you as well. So for me, I love writing notes, and I just scramble and write notes down. And sometimes I'll take pictures. So don't worry, this will come to your email and you will have access to this. All right, so today's workshop is called A Healthy Balance Sheet and Why It Matters. So we're going to learn about understanding the concept of a healthy balance sheet and learn how to create one, understand the key ratios that are used to measure a healthy balance sheet, be able to explain the actions necessary to fix any unhealthy parts of their balance sheet. What does having a healthy balance sheet mean? And how do others look at my balance sheet? What are the measures of balance sheet health? What does an investor look at, and what does the bank look at, and how can I cure, this is awesome, an unhealthy balance sheet? So it looks like we're gonna learn a lot this morning. So thank you so much. I believe Monica is joining us. She is with Business Development Canada. She has a few words, and then she's gonna pass it off to our presenter, Alex. So the floor is yours, Monica.
You know what? This is the 3rd event that Michelle's introduced me for. Let me tell you, her energy, if I can just put it into a bucket and save that for what I need, it'd be great. Yesterday during one of the presentations, the presenter started off with, we're going to be talking about finance and accounting, and it's really dry. Gosh, Michelle, the way that you do the intro for this, everybody's like, I am buying what you're selling, Michelle. That's what everybody's saying. So great job with that. So Tansei, I'm joining you from the Treaty 1 territory in the homeland Métis Nation in Winnipeg, Manitoba. I'm actually a proud Cree woman from the Peter Ballantyne Cree Nation in northern Saskatchewan. I was actually born and raised in northern Manitoba, a small northern Manitoba town. So being Indigenous in a rural community, I know what it's like and how hard it is to, you know, understand financing, you know, getting support from the community and, you know, all the challenges that come along with that. One of the things that's really challenging for our people is financial literacy. So I'm so grateful that we partnered with Cando CPA Canada to provide each one of you today. And there's also going to be some recordings from some previous sessions for you to listen to and to gain the knowledge that you need to share with your people, also for yourself if you plan to go into business or to be helping your community. So I'm really excited for what Alex is going to be presenting on today. So Alex, I'll turn it over to you.
Thank you, Monica and Michelle. Good morning, everybody. Hopefully everybody's doing well. So yeah, it's a pleasure to be here today. This presentation will help you understand the concept of a healthy balance sheet and how to create one. So I guess a little bit about myself. I'm representing Chartered Professional Accountants of Canada today, part of the Financial Literacy Volunteer Program. I've done quite a few of these presentations, you know, online as well as in person pre-COVID. And you know, part of my career, I've been working with Indigenous communities for almost 20 years as an auditor, as also as a consultant. So I've traveled to many places in Manitoba, Ontario, and even as far as Northwest Territories. So I've had clientele and you know, develop relationships and friendships along the way. So it's also, you know, it's a pleasure to be here, and I'm honored to be here today. So I guess on with that, I guess so today we're about an hour or so. You will be provided with a copy of the PowerPoint presentation after the session today. And this session is essentially designed to be interactive. So at the end of the presentation, I'll have it open to any questions that you may have regarding any of the items that we discuss in this presentation. So yeah, I mean, it's, I'll also leave my contact information. And if you have any questions regarding, you know, anything related to these topics or anything else, we can definitely have a chat after. All right, so I guess we'll talk a little bit about the Chartered Professional Accountants of Canada, or CPA Canada. So CPA stands for Chartered Professional Accountants. Accountants work with a number of businesses, you know, different communities, business organization, tribal councils, and I guess we keep businesses honest and successful. CPA Canada is one of the largest accounting organizations in the world, representing more than 210,000 CPAs across the country. Canadian CPAs are recognized and respected across the globe for their knowledge and integrities. Some CPAs work in accounting firms, while others work in industries such as entertainment, sports, technology, and non-for-profit, and many more. So depending on their specific job, CPAs can be responsible for making sure business financials add up, managing budgets, and developing plans and policies that help grow the business. So over my careers, essentially, you know, have been provided with an opportunity to work with many different communities, organizations, and business enterprises to essentially help their, whether it's their community get out of debt or help community, you know, look into developing projects or different economic enterprises. I've been, you know, luckily been part of that process and growth. So I guess the first thing I do as, you know, as an auditor or accountant consulting, I love to look at financial statements. Financial statements essentially tell you the story of the business, right? It tells you a lot. For someone that's, you know, doesn't know the relationship with a lot of the numbers, this will be an introductory to, you know, why it's important to have a healthy balance sheet. So common questions business owners ask or users, you know, whether it's chief of counsel or executive directors, board members, you know, what does it mean to have a healthy balance sheet? Why do others look at my balance sheet, right? What measures of the balance sheet I guess, how do you measure health in the balance sheet, and what do investors look at? What do banks look at on financial statements and balance sheet? And how can I cure an unhealthy balance sheet? So just to give you an idea, in the financial statements, balance sheet is essentially the snapshot or a picture of the organization or company at that specific point in time. So whether it's a month end, year end, quarterly, that's essentially, if you pick a date of December 31st, or some of the Indigenous communities report on the March 31st year end, that's essentially what we're looking at is your assets, liabilities, potentially your retained earnings, as well as potentially your unrestricted net assets. So I guess this next slide is essentially what is a healthy balance sheet. So just to give you a little introduction to this, we're going to walk through each of these bullet points and go through what it means, right? So a healthy balance sheet will show a company, if there's adequate solvency and liquidity. So what that means is, can the organization or company survive long-term as well as short-term? So solvency is more of a long-term, liquidity is more short-term. Can you meet your financial obligations, right? If you're running into cash flow problems, you most likely will not be able to pay your vendors, right? So there could be issues there long-term, and that could affect the overall success or growth of the company. Solvency is, you have the inability or you have the ability to pay your, your third-party financial institutions. So long-term, can you make your principal and interest payments, or is your company organization not having the ability to pay that? So that's going to affect how well or how successful the company does in the long term. So you also look at the appropriate borrowing, whether or not, can the organization potentially seek for third-party funding or borrowing to support some of their working capital needs, right? So can they, access additional funds to essentially pay for their, their operational activities, but as well as pay for, potentially acquiring capital assets, which may help produce more revenue for the company, right? So we look at as well as positive trends and forecasts. So we look at accountants like also not just looking at numbers, but looking at graphs. So we look at different measures there to see different trends. Is the company trending in the right direction, or is the company trending in the wrong direction? Are you meeting your budgets, right? So part of the tools that we have are, we have different ratio analysis that we use, right? So we look at something called current ratio, quick ratio. We also look at debt to equity ratios. So these are different measures that we have in place to essentially determine the health of a company. And banks also use this, or other investors, right? So these are different tools that we can assess to determine whether or not the balance sheet is healthy or not. So why is it important to have a healthy balance sheet? I guess when you look at financial information, there's always users to the financial information, right? So for some of the communities, it would be the chief and council. It would be, different funding agencies. For the enterprises, there's going to be, your partners, probably your general partnerships. There's going to be some potential shareholders. There's also going to be some investors and lenders. So these are really the ones that look carefully at your financial information. And it is important for management internally as well to understand, why it is important to have a healthy balance sheet. So when you have a healthy balance sheet, essentially that provides more confidence in your business or your organization, right? So I guess historically, whenever I worked with different communities, when there is a lot more confidence in the organization or the business, I see much more funding, which have been forwarded to the community, or there's a lot more capital reinvested, or more loans that are I guess lent out to the organizations or businesses to help build the economy for the local communities. First thing we talk about is adequate solvency and liquidity, right? So as I talked about earlier, we look at whether or not the company can survive short-term and long-term, right? So when you look at liquidity, we look at something called a quick ratio. So a quick ratio is essentially anything that can be converted to cash quickly and pay off your short-term obligations, right? To your vendors, to your companies that essentially pay for your services, or you pay for their services, or some of the vendors that you pay for some of the inventory, as well as pay for your staffing, right? So current assets essentially is your cash, receivables, prepaids. These can be converted into cash quickly, and less your inventory over your current liability. So essentially what this shows the users is if you have a quick ratio that is, over 1, that means you have the ability to pay your short-term obligations, right? You're not going to run into any short-term cash flow problems, right? We want to see a ratio that's higher than 1 at minimum. The higher that ratio is, the better it is for the organization or company. So when we look at liquidity, we look at 1 year time horizon. So another thing that we look at is something called interest coverage. So when you look at interest coverage, we look at whether or not the business is earning enough of its profits to pay its interest expense. So mainly bankers or lending companies use this as a benchmark when they look at financial information. So a ratio of 2.0 is higher and is preferred by lenders. And the reason why is that it shows that you have the ability to pay your, not only your principal payments, but also you have enough profit there to cover interest. So interest is essentially the cost of borrowing, right? So if you can't cover your interest payments, you're going to definitely run into some long-term issues. And if you run into long-term issues with not being able to pay your creditors or your bankers, you're going to have a problem with potentially violating some of your covenants, right? And when that happens, they may pull a loan, and that could essentially have an adverse effect on the company or organization. That could essentially result in potential bankruptcy of the company. So it is important that when you deal with when you're dealing with a third-party financial institution, it is important to know exactly what your covenants are, right? What do they expect? And when I mean covenants, there are specific restrictions or specific benchmarks that your financial institution is looking at the end of the year or throughout the year, right? So it's always good to have that relationship, constant communication with your lenders to determine whether or not you are permitted to, purchase additional capital assets or, look at shareholder draws. Like these are, or pay out dividends. So these are things that are very important to discuss with your bankers to ensure that, you're in line with that. Or if you're not in line, what can you do to mitigate some of those risks? So it's very important that you have this conversation as it is outlined in your agreement. So appropriate borrowing here is we look at a fixed payment coverage. So again, we're looking at the ability of a company to essentially pay off their, their lease, right? So here is, we look at the operating profit plus the asset lease payments over the interest plus principal plus lease payments. So essentially what we're looking at here is the ability of the company to pay off its lease obligations as well as its mortgages, right? Any outstanding loans. So the lenders will look at a ratio of at least 2 or higher. The reason why it's important because if you can't make those commitments, again, like I said, there could be some serious implications. You're not going to meet your obligations, and there potentially could be a loan that may be called by the bank. So we have something called adequate capital. Now, when I mean adequate capital is, is there enough capital invested in the company, and essentially to, to cover off some of your liabilities there, right? So we look at debt to equity, right? So we look at your total liabilities. Total liabilities essentially is your payables, right, to vendors. You look at your long-term debt as well, right? So your long-term debt essentially is anything that's owed to financial institutions. We also look at potentially some deferred revenue there, right? Some revenue that hasn't been recognized, which may not come into fruition unless all the services and the contract has been rendered, right? So these are essentially money coming out of the company, right? So, and the result of these liabilities is whether or not service has been rendered, or essentially inventory or product has been acquired by the company, right? And so you owe a third-party vendor. So it is very important that you monitor your liabilities effectively, as if you don't, there's going to be some potential costly, unnecessary charges to your organization or company, right? So when we look at owner's equity, we look at share capital plus your essentially retained earnings. Your retained earnings is essentially your accumulated surplus over the number of years, right? So it's money that's left in the, well, I guess it's overall, it's the surplus that has been accumulating since the opening of the business, right? Now, if you have if you have more expenditures over profit, you're going to have something called a deficit, right? So if you accumulate a lot of deficits, somebody has to fund for that deficit, right? So typically it'll be your vendors that you're funding that deficit, or essentially your loans, right? Or the owners might actually have funded their out of their own pockets some of these expenditures, right? So what we look for here is, we want to make sure, we want to try to get this as low as possible, right? This debt to equity, right? So we take your total liabilities over your owner's equity, and lenders prefer a number of 2 or lower, right? So that means you have less debt compared to your overall equity, right? How much you invested. So the lower the number is, the better, right? So essentially, this will measure how leveraged the company is, right? How is it going to meet its long-term as well as the short-term debts. That was something called working capital. Working capital is a measure of the liquid assets available for the operation of the business, right? Simple formula. We have something, we take your current assets less your current liabilities, and essentially that becomes your working capital, right? So on your balance sheet, you should have current assets, which include cash, inventory. Inventory essentially is items that are going to be for resale, right? You want to turn over inventory as soon as you can, or as fast as you can. There are specific ratios we look at called inventory turnover, that determines how long you've had the inventory in stock. So depending on what type of business you are, if you are a business that sells highly perishable items, such as a grocery store, for example, if your inventory has limited shelf life, you want to make sure you turn that over and sell it as fast as possible. The reason why is if they become spoiled, essentially that's money out of the business, right? There's some companies there, whether they're tech companies, and some of these tech companies have assets or inventory that are highly susceptible to change, and technology is very short. So you want to make sure you turn this over pretty quick. So it's important that when you're dealing with inventory, you sell them off as fast as you can. Or you may be running into some valuation issues and have to write it off. Accounts receivable, essentially these are monies owing from your clients for services rendered, or whether you sold them a product. So it is important that businesses are proactive with respect to collectability of receivables. If you have receivables that have normal terms and conditions of 30 days, if you have them sitting on your books for more than 60 months, essentially there's a higher chance that you're not going to collect the full amount of receivables, so you may have to write it off. So, and there's also interest charges as well. So it's important that you do collect, you do have some policies and procedures in place for management to oversee that receivables are being collected on regular basis and being monitored carefully. Accounts payable, so those are your current liabilities. So your current liabilities, again, these are for third-party vendors, or I guess for different types of vendors that perform services or have sold you a product. Again, these are things that you have to monitor, because if you don't monitor them carefully, you might have issues with your collectability, essentially, or sorry, issues with paying off, and you might incur interest charges unnecessarily. Excuse me, 1 second. All right, so next thing is trend analysis and growth rates. So we're looking at, sorry, 1 second here. So trend analysis and growth rates. So what we're looking at here is, we look at different things that we compare relative change in values of period over time. So when we look at different growth rates, we look at things that are increasing or decreasing or staying the same. So when we look at different types of, we look at financial statements, we look at the balance sheet, we see what the numbers look like comparative from prior year. We look at, how is it trending? Is it trending in a positive direction? Is it trending in a negative direction, right? So it is important to monitor this carefully, because, if we see that it's trending in the wrong direction, that means there's a possibility that we could have run into issues with, liquidity or solvency as well. So it's important that you monitor these changes. Important. So we look for spot trends. So spot trends essentially are, is there something in your business model right now that is very successful, right? If so, how can we capitalize on that, right? Can we maybe look at contacting the banks to possibly lend us more money, essentially to help grow that business sector, right? So it's important that you do look at these trends to make sure that capitalize on those opportunities, right? And if you see that there's also a trend, an area in your business that's not trending in the right direction, what can you do, right? So I'll give you an example. So we'll go back to inventory. So if you see that your inventory is, it seems to be selling quite a bit, and there's a higher profitability ratio, I guess, gross margin on it, you want to make sure that you essentially try to try to get access to more potential cash, whether it's through your bank or investors. And you want to essentially capitalize on that market. So you want to get it to more, I guess, consumers, right? So, but you don't have enough cash to fund the inventory. That's when you want to talk to your bank and say, we're trending in the right direction. We have a potential, higher profit, higher margins that we're earning, but we need more access to capital or cash. So we need to be able to tap into this and take the opportunity to essentially grow this market. So it is important that you look for specific trends, not only in your business, but also look for trends in your marketplace as well. So I guess when COVID hit, definitely a lot of businesses were either negatively affected due to closures, but there was some that really flourished, right? So a lot of businesses that sold products online, there was a lot of increase in e-commerce. So it was amazing how some of my, I guess, clients have taken advantage of, getting more capital or loans from the banks to essentially capitalize on some other opportunities there, right? With their online sales. So it's very important that you spot the trends, right? If you see that potentially that you may need some more capital for essentially for to if you see that maybe you need more machinery to produce more products or do some of the work that you're required to do, it might be important that to contact your bank there and see there's an opportunity here for us to grow or go into this market, but we don't have the cash to do so. It might be a good opportunity for you to sit down with your banks, go over your financial information, and propose the business plan. So it is important that you look for trends in your business, and it is important that you look at your financial information. And I guess with any type of trend analysis, it's important to analyze your product and your services as well, and strategize, right? So again, with the pandemic, changes to the marketplace itself, it is important that you get a good idea as to where you want your company to go, where you want the business to grow, what you need to do to essentially get to that point, right? So it's very important that you understand your financial information, look for your strengths, weaknesses, and really capitalize on a lot of these trends. So here we got essentially a tale of two companies. So we have Firm D, as you can see, they're budgeting $80,000 per month on receivables, and it looks like it's increasing. It's going from 80,000 to 100,000. So there's two things here. This could mean is they're either selling a lot more volume, all right, but the bad thing here is they're increasing their actual receivables over time. Again, it could mean that there's more sales, but it also could mean that if sales are constant but the receivables are increasing, it could mean that essentially they're not collecting their receivables on a timely manner. So from January to July, their receivables have moved from 80,000 to 100,000. So that extra $20,000 a month that's held up in receivables, that's cash that's not being collected. That $20,000 could mean it could run into the company could run into some liquidity problems because it's not collecting its cash and it's not meeting its short-term obligations, right? So whereas Firm G, for example, it's they budget $80,000 per month on receivables. Some months it's higher than it's trending from 80,000 to close to 100,000. But the good thing is they're budgeting 80,000 is what's in their receivables, but they are collecting their receivables actively. So as you can see here, you want to make sure that if you're budgeting $80,000 a month as your receivables, and if your sales are similar, you want to try to collect as much cash as you can, right? So it's important for organizations, managers, to have policies and procedures in place, and to actively have a department possibly or an individual that's responsible for collecting the receivables, right? So this is important because the longer you have your receivables on the books and not collected, the less likely you're going to collect the full amount, right? Some clients may forget that you do the work for them, or some clients are just avoiding paying you because they may have potential cash flow problems. But my recommendation is contact your clients directly, and if you see that they have problems in paying, make arrangements, right? It's better to collect cash slowly over time than not to collect your cash at all. So it is important that you continue to establish that relationship with your clients to make sure that everything's both sides are in agreement with this. And because if you don't collect the cash, you will end up in a potential cash flow problems. So there are different users that essentially look at the financial information, right? So banks, credit union, and other lenders. So BDC is a company that I work, I guess we have mutual clients with, and we work well together. And we provide financial reports to BDC from our clientele, right? So there's a requirement for the banks to essentially provide with that information to, I guess, the company has to provide information to the banks for several reasons, right? And I guess they look at to make sure, one, that you have the ability to pay for your debt to them. You're in line with the covenants, and if you're in line with the covenants, you're making their payments on time. You're paying down your balance on time and on par. There's a higher chance that your company could potentially obtain much more bigger financing for other bigger projects, right? So it's really important that you file your financial statements on time, because the banks have, I guess your lenders have a responsibility to their company as well to ensure that you're in line with your covenants, right? If you're not in line with your covenants, then they might pull the loan, right? So typically the banks are relatively hands off with a lot of their I guess your business operations. It's good to have that relationship with your banks though, right? On a periodic from time to time, because if they they may provide you with more access to cash or capital if you need it to help your business grow, right? So I know I talk a lot with some of the BDC representatives there, and we always look at opportunities for our clients to essentially build their business, right? So we look at the financial health of the company, and again, we look at ways in which we can work with the businesses to help essentially grow their business. So it is important that you have that relationship with your banker, so you can have a lot more access to cash if needed. Or if you do run into problems with your operations, it is important that you contact them right away if you can't meet your obligations. And if you can't make your obligations, there's definitely some room for discussion there. And because if you're not in line, like I said, I've seen banks pull the loan, but typically banks will work with organizations or businesses to ensure that they could continue their business, right? So there's other users are investors. So as an investor, you become a partner. I guess they become a partner of your business, right? So whether you're in a community where there's if you're a general partnership of a company, or there's different projects that you're working on, but you don't have access to cash and potentially you can't get a bank loan, you have to look for outside investors, right? So the investors essentially become your partners of your business, right? A lot of these investors have deep pockets, so they're very, they're financially savvy. They understand financial statements. They are, some of them are prudent investors, and they definitely mitigate their risk. They look at the risk of the business, what the possibility of them, as an investor to turn a profit, right? So they're more concerned about their return on investments, right? With having partners or investors, especially those that are wealthy, they have access to connections, right? So a lot of them have, access to different companies that could help essentially build your business. So as well as they have, because they are successful business leaders as well, they're focused on growing your business as well, right? As a partner, right? So their main focus is to look at the risk. They look at your balance sheet. If it's, if there's something there that may not be, profitable, or if there might be a business line that might be profitable, or if you're not, collecting receivables, or you have some assets that may not be, that might be redundant, they'll help focus on specific weaknesses in your business and essentially assess it and try to help move it forward in the right direction. A lot of them, some business investors they have financial expertise, right? So they understand financial information, and they can see essentially, trends, right? They know exactly how to read financial statements. They'll look at areas where there could be some potential issues with your financial information and address the issues, right? So an example would be, your margins are low. Why is your margins low for, the type of inventory that you're selling, right? Is it because, maybe you're not looking at the right vendors, right? You're not negotiating some of your with your suppliers. So they may have that opportunity to negotiate with your suppliers for better rates or, less costs, right? So, or they're, they might see that, you're paying too much for insurance or you're paying too much for a service. So they may look for the same type of service at a lower cost, right? So the only problem when you have with when you're dealing with investors and they become your business partners or shareholders, they can be very intrusive. There's something called Unanimous Shareholder Agreement, which is essentially an agreement that you as a shareholder sign with each other. Essentially outlines, your responsibilities, how the partners get paid. If there's a buyout, who buys out the business. So there's a lot of things there that are outlined, and as a business owner or a shareholder, they're going to be asking a lot of questions, right? Whether it's financial information or just general questions about the business. So they'll be in the business and they will ask important questions that are sometimes difficult questions to ask, but those difficult questions to ask are essentially important questions to ask so you can address the problems, right, and move forward. It also can trigger painful revisions in performance targets if they're not hit. So what that means is, if sales are not being met, it could result in people being fired. It could shake up the business, restructuring. So if there's, for example, management's not meeting the expectations of specific projects, there's a lot of cost overruns. There's going to be potential for essentially, people being moved around within the company, or again, let go, or there's going to be much more, further discussions with management team as to how they're going to be profitable, right? So there's many things that can occur here with respect to if you're not meeting targets, or if you're meeting targets, that could be a good thing for the organization, the company, and the employees involved, right? So as a shareholder or investor, your main focus is one, return on their capital, right? How fast can they take that 100,000 that they invested in and turn it into 500,000? So it's essentially, that's what they're looking for, is a return on their investment. So as an accountant, as managers, we essentially look at ways to essentially, if we see that there are issues with your financial statements, your balance sheet looks unhealthy, we really need to identify the symptoms, right? What's causing the unhealthy balance sheet, right? So when you do your ratio analysis, right, your quick ratio, your current ratio, your debt to equity ratio, we really need to determine what's the root of all the cause of an unhealthy balance sheet, right? Is it that you're not collecting receivables quick enough? Is it that your policies in place for receivable collection is not adequate? Is it potentially management not adhering to budgets, which is the result of why there might be some cash flow problems, or again, we're not turning inventory quick enough? So we need to really get to identify what specifically is causing the unhealthy balance sheet. Perhaps the business has changed, right? The business model needs to change. Perhaps the economy is turning over, or the market itself is changing, right? So these are things that business owners, managers, executive directors need to take a look at to essentially determine what is causing the unhealthy balance sheet, right? So again, we need to identify contributing causes, right? Sometimes it's just not one cause, right? It might not be, one of your clients goes out of business, right, and they owe you quite a bit of cash, right? So your receivables are essentially essentially going to be written down. So it might not just be from one cause, there could be many different causes, right? So again, the economy has a huge impact. The COVID pandemic had a huge impact on many businesses. So it's really determining what you should do is essentially look at your numbers, you know, understand it. What can you do to mitigate those risks? You know, talk to your accountants, talk to your bankers, your investors. Like, what can we do to essentially mitigate these risks? How do we get out of this situation, right? Do we just, you know, perhaps we're taking too much risk here, and you know we're going to lose a lot more money. So do you just, you know, stop and cut your losses, or do you come up with a plan or strategy to essentially address those risks, right? So it is important that you come up with an action plan, right? So when you come up with an action plan, essentially you have to put measures in place, budgets in place to essentially come up with that. So it's just not about numbers. It's also about also putting together qualitative you know, measures there. So it's like putting together a business plan, right? So you know, so I do some consulting work for some clients, and some of them have, you know, asked me to develop some management action plan or a business plan. And, you know, we go through a lot of the qualitative considerations. You know, we look at market analysis, we look at even some of the HR, and we look at, you know, we strategize, right? What can we do better to essentially grow the business, right? So a big part of it is forecasting, right? So we look at, you know, what potentially could impact the business, right? Do we look at potential contracts, potential capital investments, whether it's buying new equipment? Will buying the new equipment essentially take our business, or I guess the business, to the next level? So these are things that we need to take a look at, because they do have an impact on your bottom line, but also has an impact on your overall you know, balance sheet, right? Your cash, your receivables, your payables, your inventory. So as well as your debt, right? So we need to look at forecasts, and we have to look at it from a realistic perspective, right? Sometimes when you're optimistic and you create unrealistic budgets and unrealistic targets, sometimes that becomes a problem, because, you know, you spend more, or even, you know, you spend the same, but you could also spend more. And at the end, if your sales are not coming in as anticipated, you're going to run into huge, you know, deficits, and you're going to have to borrow more from the bank, or, you know, you're going to run into short-term problems with paying your vendors, right? So when that happens, it's going to, you know, there's going to be much more costly, unnecessary interest charges, or, you know, I guess there's going to be a relationship issues there with some of your vendors, where you used to have good relationship and used to have better terms and conditions. So they might not be too keen on lending you more money, or they might not be willing to, you know, negotiate better terms and conditions with respect to purchase of inventory if you have you know, ruined a good relationship because you don't pay your bills, right? So and it is very important to revise the plan as necessary, right? So again, with plans are always changing, right? Whether it's on a monthly basis, you know, quarterly basis, or annual basis. It's essentially important that, you know, everybody involved with the financial reporting aspect, whether it's, you know, your accountants, your bookkeepers, executive directors, your investors, your bank. It's important to keep them in the loop with how everything's progressing, right? And if you need to change your plan because, you know, you haven't met your targets, do so, right? Change your budget, right? And always constantly revisit your budget, right? And compare it to your actual results. And it is important to do so because, I mean, if you continue, like I said, to operate as is without changing it or revising your plan, you're going to run into some serious issues, right? But if you have the opposite problem where, you know, your sales are trending in the right direction, you know, that there's also other potential issues as well, right? I mean, if your business grows so fast, you might not have access to cash right away to help grow that business. So it might turn away potential businesses, right, or opportunities if you can't service or deliver on the product, right? So it is important to essentially monitor that and revise your plan as necessary. So some issues to consider as well is when you're looking at how to cure unhealthy balance sheet items, some things you want to look at is distributions to shareholders. You have to consider this because anytime you pay yourself or pay your shareholders a dividend, that's money that's coming out of the company, right? So by taking out excess amount of dividends, that could negatively affect the overall business itself, because now that 100,000 that was taken out as a dividend is now taken out of $100,000, which could otherwise pay for the operational expenditures, right? So that could have an adverse effect on the overall, I guess, cash flow for the company. We also need to look at, poor profitability, revenue too low, and poor cost control. Again, this ties into your budgeting. If you see that your business is trending in the wrong direction, again, it is important to potentially change how you're doing business as well. Potentially, if you're losing on too many contracts, or and these are things that you have to consider. Perhaps you're aggressively pricing yourself out of the market, or if you're not making enough profit, perhaps you're pricing yourself too generous and not making your margins. And when you're not making your margins, you're not going to be able to have the ability to pay for your operational costs. So that's going to have an adverse effect on your bottom line, as well as your overall profitability for your business, and thus affecting your cash flow. So included in the package, you will get a copy of glossary of terms. There's going to be an implementation checklist as well, and information from, I guess, BDC Canada as well. You also get glossary of terms. So the different terminologies I have described throughout this presentation will be available to you there. So at this point, I would like to open up the floor to any Q&A.
Awesome. Well, thank you, Alex. You covered a lot. You covered a lot of ground. So in a moment, we're going to ask any of the folks joining in if they have any questions. Feel free to unmute yourself. Feel free to use the chat box. I have a question. It's pretty, there's no such thing as a dumb question, right? Okay, so when I'm thinking about, people who are potentially wanting to get a loan for their business, how are the interest rates? And did I hear that they are gonna go up this year?
I
guess, Monica, would you like to answer that question?
How are interest rates? One thing I will tell you is shop around, but cautiously. And so when I say, obviously shop around is fairly obvious, but when I say cautiously, financial institutions use your credit as an indicator of your ability to pay back your debt. So if you go to 5 places within a matter of a month or 2 months, your credit is going to go down substantially. And that's one of the things that people that are looking for money, is either starting up or expanding their business, that they might not know about, but going and shopping around can really affect your credit.
Oh, okay. That's really good knowledge. Thank you.
Yes. And then the other thing is about interest rates. I will tell you, if I knew what's going on with interest rates, I would not be in this job if I had that crystal ball. But what I will tell you is that rates are at a they're at an all-time low right now. The other thing, the misnomer I'd say in regards to rates, is people say, well, my residential mortgage, if somebody has a mortgage, is fairly low. You'll never get a commercial mortgage at that same low rate, nor will you ever get equipment financing at a residential rate. Or when you want working capital, it's even higher. So working capital is if you need to buy inventory, you want to work on a website, you need a marketing strategy. There's nothing tangible with that. So your interest rate's going to be higher.
Okay, good. That's really good. Again, really good to know. Thank you.
Mhm.
Alex, you did touch on, what do investors, lenders want to know? And this afternoon's presentation, I think we're covering that a little bit more. So if that was something of interest to you, join us this afternoon. So anybody else, does anyone else have any questions, comments for Alex? I mean, I feel like you gave us a lot to think about, Alex. I'm a small business owner myself, and I felt like this kind of presentation would have helped me many, many moons ago when I was starting out. And I mean, it's absolutely applicable today for my business as well. So thank you for that.
The other thing I just want to say, Michelle, is that for anybody that has a professional accountant that they're working with, go to them and ask them questions. They're very knowledgeable. And I always say, entrepreneurs, you need to wear 10 hats. You can probably only wear 3 really well. And the 3 that typically suffer are finance, accounting, and maybe setting up a website, because going out there, you need to have a really good strategy. It's not just about going on social media, and it's not just about setting up a website. You really need a strategy. So your professional accountant will be able to have that accounting, finance speak with you, and they're able to help you to really read through your financial statements and help you if you're going to look for more money, what banks are looking for. But use them as they're on your team. Remember, they're part of your team, so definitely use your accountant.
Yep, that's great. All right, so from Desmond, good knowledge. Thank you for the presentation. I concur, Desmond. Thanks for joining us. Well, thank you so much. I felt like I had one more thing to say, but it's gone. I'm overwhelmed with knowledge right now, good knowledge in a good way. But thank you so much for lending your time and lending your knowledge this morning. Alex and Monica, pleasure. I'll see you this afternoon again. But thank you all for joining us. I hope that the sun is shining in your day. And if it's not, I think in Manitoba, Alex, you said it was a little overcast, but I hope you are able to find some sort of sunshine in your day, some goodness. We have the good, the bad, the ugly with us always, but always look for that good. Always look for the beauty, because it's around us everywhere. And even in this financial stuff, this is really, really important, for the integrity of our businesses and our communities. So thank you so much for your knowledge. So have a good rest of the day, everyone.
Thank you.
Bye. Thank you.
Bye.